Tony, how are you?
Hey Jim, what's going on, man? How are you?
I am peachy keen. How are you today?
Doing well, working away.
Fantastic.
Yeah.
So, is this a catch-up phone call, or are you actively raising right now, or
I'm
what did
raising right now. This is us just getting together. I know that I don't think we've ever chatted before, except on maybe like a Tuesday during the GOB. Yeah, just you reached out to me on LinkedIn and said, let's set up a call. And I was like, all right, let's set one up.
Fantastic. So I think that was in regard to one of my posts about having a bunch of deals and needing some extra capital and people that are raising capital to see if there's, some synergies there, and if there's any deals we can work together on.
Yeah, I mean, where are they located? What do you have?
I've got deals all over the US right now. We're putting together a bunch of deals, and I've got land up deals. I've got RV parks. I've got smaller multifamily. I've got larger multifamily. So we're probably going to do between 40 and 80 deals this year. And what is your criteria for what you're looking for to work with someone?
So on the GP, I'd like to have a strong share in the GP side, number one.
Okay.
Now what that looks like is dependent upon the deal, obviously. But to raise, it's got to be, well, basically what I want to know, because you've got all different kinds of offers, like what are you typically offering on your end? Because you've got all different kinds of
for
deals.
the capital raise, it's pretty standard, pretty much what everyone else is doing, trying to set aside a third of the deal for the capital.
Okay. So is that on a benchmark system? Like, so if you needed $1 million in capital, if someone brought in 800,000, would they get the larger share of that?
No.
No. Okay.
No.
Okay. So
no, I don't think that's fair.
No, it's not really
because
legal.
It means you're going to cheat somebody else.
It's not legal either.
Yeah.
But I've seen it happening before.
Whether or not it's legal depends on how you structure it.
Right. Yeah.
And the reality is, if you're in this business or have been doing it very long, you know that everyone pays based upon how much you raise. I mean, that's just the bottom line.
It is. So basically what I'm looking for is to have a strong position on the capital side, and then also be able to take advantage of the strengths that I have on the underwriting, investor relations, and acquisition side. So in my W-2 job that I do right now, all I do is underwrite deals. So I mean, it's really that's what I do. But
and Tony, do you do that on multifamily or commercial or some other type?
In my W-2 world, or
in your W-2
no, I just do it on portfolios of single family homes. So
okay.
It's the same as multifamily. It's just on single family assets.
And usually large portfolios.
Yes.
Yeah.
So I do it for institutional. I do it for institutional investors. So
okay. And do you work for a private equity firm, or is it a due diligence firm, or a consulting firm, or what does that look like?
I work for a prop tech company.
Okay.
Yep. So I work for Mind Property Management, and what I do is I'm in acquisitions for the company. So we have 3 different legs. You can do retail acquisitions. So Jim wants a house in Atlanta. You can come to us and facilitate that entire transaction, from acquisition to lending to property management. You can get all 3 in one shop.
Mm-hmm.
I am on the institutional buying side, which is just, I'm the side that most people don't see, because I'm not working with your retail side. So, but yeah, that's pretty much what I do all day. Is I understand market nuances. I understand pretty much all the markets that are where the market is going in terms of a national scale. And then I understand it in terms of like a microeconomic perspective as well, like per city,
So do you guys, what tools do you use for your market research?
So we have some proprietary tools that our data team puts together. It's a bunch of people that have worked for other prop tech companies like Zillow, Redfin, Open Door, and some REITs and some private equity firms that came together, built this, and just basically put out a big data model. And that's how we were able to see, kind of like, nothing is ever true to perfection, as you can imagine. Things change, but we're pretty solid on being able to understand where the path of progress is usually going. Like, for example, at a high level, a lot of people are interested still in investing in the Sun Belt. The Sun Belt is no longer existent for the bull run that it was on. That belt is moving north. You have to see, I mean, we got to see that. That belt is not just staying in Florida, Texas, Arizona, across the nation. That belt is moving towards Cincinnati, towards Indianapolis. It's moving up. And the reason why is just because as interest rates take their hold, it's going to be hard to make sense in these more expensive states.
So are you guys still actively buying?
Oh yeah.
Okay.
Yeah, for sure. But like I'm saying, like on an institutional side, institutions don't need as much in returns as like we do.
Right.
So they can buy anywhere. They can buy, I mean, if it were legal, they could monopolize the entire industry and force all of us out, because they could just go buy everything for 1% return and then they'd be fine. But it's not legal. But that essentially that's what we do. So we buy all over the place. We buy in Florida, Texas, Arizona, Atlanta, North Carolina, and a couple other ones. I think we just opened up Memphis and Nashville, Indianapolis, and then we're moving out to Vegas and Reno in the coming months.
So on the multifamily side, are you working pretty much by yourself, or are you working with a team?
So on the fund that we have right now that we're raising on, I'm a part of a team on that one. And then I also do golf course investing, and I'm a part of a team on that too.
So is that two separate teams, two separate funds?
Yeah. Oh yeah. The golf course side is people that have been in the golf industry for 50 years. Yeah.
Yeah, I wished I was looking at a few golf courses 5 years ago, and wanted to buy and just couldn't, convince any of my multifamily people to buy. And my God, did we pass up on some really awesome deals.
I tell people all the time that they are cash cows if you operate them the right way. Now, the ones that you see that are not operated, like that are losing, it's because they're not being operated the right way. But when they are the cash cow of the world, it seems like. I mean, it's pretty incredible.
Yeah. So on your fund, how many people are on that team for the multifamily fund? And is it just strictly a multifamily fund, or is it just a real estate?
It's just it's multifamily right now. There's four entities involved to create one entity.
Okay. And how do you guys break it down? Are you all taking an equal share in the fund, or is someone kind of the head of the fund?
Yeah, I mean, like we have someone who's kind of taking that lead role of, because you can't have two leaders going on at one time. So we have someone that took the lead role, but we all have equal share in the fund.
Okay. And do you guys, do you have a buying criteria for the fund, or is it just kind of deal by deal basis?
It is a deal by deal basis. Yeah,
okay.
Sure. Yeah.
And do you guys just collectively sit down and look at a deal and vote on it and say, I like this one, I don't like this one? Okay.
Yeah. Or we'll have people bring it to us, like if it's a fund to fund model, that we like their fund that they're already in and we want to raise on that one and come together, then we look at that side as well. Yeah.
Okay. And do you guys, do you ever come in on the LP side with the fund?
Sometimes. Yeah. So this is our first one. So we haven't really delved into like the schematics of like how we would scale this, but this is our first one. But yeah, I think that would be a way that we could potentially negotiate around that. Yeah.
Okay. And are you guys, are you looking for a particular deal size or a particular deal type for this first one, or are you just feeling your way right now?
We already have the 3 assets in the first one. We already got them.
Okay,
So
so you set it up for 3 assets?
yeah, it was set up. Yeah, it was. We moved into another fund on this one. So there's 3 assets in it. It's a diversification fund. So instead of like, you've probably seen funds that have like 3 Class A assets in them.
Yeah.
That's a really, in my opinion, in my humble opinion, Tony's opinion only, I think that's a bad model, because what it does is you're not able to spread your risk efficiently. But this one is literally 3 different business plans wrapped up into 3 different assets. So
Okay.
you're more than welcome. I put the link in my content today, so you can definitely go look at it.
Fantastic. You say in your content, you mean you made a post?
Yeah, I make a post every day on LinkedIn.
Okay.
Something creative, and my link, the link to the portals in the content or in the comments.
Okay. All right. Well, in this fund, are you guys looking for A-class assets, B, C? You know,
So this fund, in this fund that we already are right now, the assets are already there. So we didn't look for them. We came in on someone else's fund. So it's a fund to fund. It's a fund to fund model.
Okay, but the fund that you're trying to raise for now, what are you looking for there?
Just honestly, true diversification. So I think the best model, in my opinion, like I just said, is where you have like one really, really strong value add, and then one really, really nice new development or Class A asset to kind of counterbalance the risks there. And then you have one where there's not really a lot of value add, just the owner just isn't taking advantage of optimizing the rents there. So I think that, like, in a perfect world, that's how you would structure it. Now, I think that there are places in the country and markets that if you had 2 A-class assets and 1 value add, that it could work. Like, I think that would work in Phoenix right now. I think that'd work in Dallas right now. I don't think that would work in Tampa, because Tampa is, I think it's getting to the ceiling there, because you're running out of room down there. Like, there's just no room to build anything. So everything is just going to hit a capacity that eventually people are, or you're going to start having people rather sleep on the street. It seems like, I mean, they're just boosting rents to a ridiculous level down there. I just don't think it's sustainable. But like Texas, I'm sure you have some stuff in Texas.
I do.
Texas doesn't boost their rents like Florida did. Texas is really linear. So they'll, for whatever reason, I don't know why, but they're really smart, and all the investors that I know in Texas are really smart about optimizing and efficiently boosting rents, instead of going 6% and then 6% the next year and then 6%. I mean, it's just, I don't know what it is about the difference between Florida and Texas, but the investors that I know in Texas just seem to be operating a lot smarter, in my opinion.
So you're looking for anything from ground up A-class new development to a heavy reposition?
I wouldn't say like heavy, but definitely a play that we have some value add, that we can go take 50% of it, value add it, and boost the rents that way. Yeah.
Are you interested? Are you guys interested in any LIHTC opportunities?
I don't think so. Okay. Just because, only reason why is just because you run into some government things there, which I try to stay away from that. You run into some other challenges with legal. I just don't think that we're at that point yet to be dealing with that.
Okay. Well, we've got deals right now that run the gamut. We've got A-class stabilized. We're buying a couple of 2017, 2018 assets in the Midwest that we're raising capital on right now. We've got a brand new ground up A-class that is really townhouse condo type, but we're actually going to market it as apartments, but we're going to set it up as condos so that we can have multiple exit strategies.
Right.
And so that's ground up. We've got entire neighborhood repositioning projects that we're working on, where we see a lot of new employment coming in that, and it's just needs a big boost. And so, yeah, literally, I've got brownstone projects, that are A-class brownstone projects in the Midwest. Just pretty much run the gamut. So, if what do you guys how much capital are you looking to deploy? $1 million, 5 million?
So like right now we're raising on it. We got to raise $5 million is what our target is.
Okay. And are you going to raise all that before you deploy, or are you going to start deploying as you're raising?
So that's up to the primary fund. That's up to the primary. We're the fund of a fund. So it's up to them, really. You know what I'm saying? So like if you were a fund and we decided to raise on yours, we would be a fund within a fund. So you would be the kind of like the controller of when that capital is deployed. As long as they deploy it within the parameters and the legalities that they said they would, then that's where we're at.
Okay.
Ideally, I would rather, if it were Tony's druthers, I would rather raise it and then give a set 6 to 10 week time period of deployment, because then instead of having to rapidly deploy as it comes in, you're able to find quality assets and deploy them on a whole basis instead of trying to get in and out the door right now. You see what I'm saying?
Yeah. If you guys, if you want to do another fund of funds, I just opened up a fund that is a very diversified evergreen fund, and I'm going to be putting a lot of assets in there. And so the assets will already be owned. So there's no risk for the capital. The capital is just to come in and look and pick and choose which pieces they like, and just deploy within the assets that are already there.
So what kind of deal can you give if our fund were to raise on your fund?
That's interesting because my fund is set up as a nonprofit. So I don't, my fees are just to cover my cost. So you would have to set up a fee structure within your fund that allows you, like, how much are you guys charging for fees on your fund right now?
I have to look. I'm not the captain of it. I can get with our captain on that one, but I'd have to look. Yeah.
So you would have to do it within your fund. So we have in a fund to fund models where people have come in and they're primarily coming in and all of their capital is being deployed on the LP side. And then they're taking a percent. Like, do you know Dave Thompson down in Austin?
I think so.
He raises all the money for Joe Fairless. And that's the model that him and Joe use. So Joe, he brings all of the money into a fund that he operates, and then he deploys the money into Joe's fund that buys the assets, and he takes his cut from his investors. So if Joe needs, say, $1 million, he knows he's going to raise like 1.3 because the 3 is going to be his fee. Or he'll give Joe, instead of $1 million, 800.
Okay. Yeah, that makes sense. Okay. I think this is just something that we, like right now, from a time commitment standpoint, I'm pretty strapped because like I said, we just got a golf course LOI accepted up in Chicago. So
really? Which one?
It's over in Joliet. I don't want to divulge too much because we still haven't signed
you make sure that you send me the PPM once you have it together. And if you guys need any additional help on golf courses in particular, any specialty asset, golf course, winery, things like that, I'm very interested in finding some of those myself and buying some or partnering with some other people to buy some.
So what we need right now is we need listings. We need more of them because like capital, we got people like this one right here. Once we get it signed and sealed, we've already got one fish that's gonna deploy the capital for it. I mean, it's the cash flows are really solid on it. But what we need is more opportunities. We just need more at bats. That's what we need. Because they don't trade like multifamily does. You can put a box on the corner and you can have a multifamily asset. A golf course, there's not as many of them. So they don't trade as much. So yeah, we just need them we like the Chicago area, but we look all over the place. We just need at bats. That's really what it is. Got to be public though. No private, no munis, no privates, nothing. It's got to be public for us to even take a look at it.
Yeah.
Just because I don't want we don't want the bureaucracy of private events. You live in
Yeah.
Chicago, right?
Yep.
Could you imagine trying to go buy Medina if you did get it? It'd be horrible.
Yeah.
You'd be dealing with all those members. It would suck. It would be
Yeah.
absolutely horrible. So, yep, it's got to be public.
So
Once
are
we
you
get-
guys, what size public are you willing to go after, and what does it need to look like? Like, what are some of the parameters that you guys are
Yeah,
looking
yeah. So it's got to, number one, it's got to have a good drive time population. That's why we like Chicago. So, I mean, you can go pretty much anywhere west, which, I mean, you can't go east in Chicago. You'll hit a lake. But I mean, if you go west, there's some good stuff out there. We ideally want it within, if we could have 1 million people that would live within a mile radius of it, that would be great. Sometimes that's not always ideal, but if we could have one that with at least 700,000 people that live within a mile radius, I mean, that would be great. 5 mile radius up to like 3.5 million people. I think that would be solid. It's got to have a good driving range. It's got to have a restaurant.
So you said it doesn't have to have a driving range?
No, it has to. It's got to have.
It has
It's got
to have a good driving range and has to have a restaurant.
Yes. If it doesn't have that, it's not going to fit. Just from
or at
just
least
because
to have space for a driving range, or you want the driving range to already be up and running?
I mean, if there's space for it, we could build it.
Yeah.
Ideally, I mean, as you can imagine, just like in multifamily, you don't want to go. If you're going to do a development play, you need to get your belt on to go do that. It's a lot different. So if it's already there, we can optimize that a little bit better than we can just go, tearing trees down and doing that, because that brings in all kinds of permits and all that kind of stuff. But hold on, there we go. That brings in all that kind of permits and all that kind of stuff. So I would say that it needs a good driving, like a really solid driving range. It's got to have a restaurant space. It's got to, because if we can't use food and beverage, you're in Chicago, you have the potential to lose 4 months of golf in a year. So we have to find a way to optimize 12 months worth of revenue. So, it's stuff like that. I'm happy to send you the PPT of the one that we have just to look at.
Yeah.
And then
how are you guys kind of rule of thumb? What is your you gave me a couple of up and down. If it doesn't have a driving range in a restaurant, okay, move on. But from the financial standpoint, are there any other metrics you're looking for that would be kind of like, if I find a few, what would I need to look for to bring it to you guys to see if you would be interested in partnering with me?
Honestly, because it's, and I don't say this for any other reason than what it is, Jim. Honestly, it's we got to see the golf course first. You ever look at a multifamily asset and you can tell if it's going to work or not? You can just tell if there's like too much deferred maintenance, or it's, we got to see it, because if it doesn't fit the eye, like it doesn't fit like what we can conceptualize, then the financials don't matter. Because take Medina, like I just said, Medina has a huge driving range. It's got a huge restaurant, giant clubhouse. The fact that it's private. So we got to see it to even start delving into that. So that's that. I mean, because golf courses sell at different amounts of money. So if we had one that was $20 million to go buy, we could get the capital for it. It's just, it's got to be worth it from the actual physical golf course side. That's really like the key player of it.
Okay. Do you guys have local boots on the ground in Chicago that you're using or depending on to go eyeball properties?
We do not right now. The one that we just got an LOI accepted on, that's our first up in that area. So we don't have boots on the ground right now. But that is to say, if you find one, send it my way and I'll say, yeah, that one fits or doesn't fit or something like that. And then if we need to fly up there to take a look at it, if it fits everything, then we'll fly up there and we'll keep you involved from there.
Okay.
Are you a golfer by chance?
I love the game. I'm absolutely horrible at it, but I love the game. I could retire just sitting in the lounge or the bar at a golf course, just listening to guys talk about their game that day and going out and putzing around and hitting a few balls. But yeah, I'm very, very fast. So I don't slow down any of my friends who are really good golfers. And that's all you have to do to get in a little golfing club is don't slow anybody down.
I agree. I'm about to run out here in a minute and go play here in Green.
Yeah.
But
if it's any help, the level of my game, the foot wedge is the best club I have in my bag.
Yeah. But yeah, I mean, like at a high level, that's really what it is. And that's only because you can't really gain a criteria except for the type of course that it is in golf. You can't, I mean, it's either got to be private, municipal, semi-private, or public. Only one of those is going to work for us. I don't want a private deal. It's just too much political bureaucracy. It's just garbage. So public, definitely we'll take a look at it. And just like in real estate, most of the deals that you see are crap. They're just not good. So yeah, that's really what it is. This is my first one. So I'm excited about it.
Yeah, I had an opportunity to buy, oh my God, I'm going to forget the name of the course now. It was owned by the Homeowners Association over by Valparaiso, Indiana, which is a bedroom community of Chicago.
Yeah.
And really beautiful 18-hole course, and has a decent driving range, but had no clubhouse and no conference center. And that was the play. And it sold for $700K. But that was one of those, back 5 years ago. That's the kind of, the kind of deals that were going on at the time.
Oh yeah. Now, if I was in the game to do, which I'd like to do one at some point, to have like an exclusive where it's members only, by invitation only. It's kind of like my little retreat type thing. I'd like to have one of those and invite, buddies.
It was actually a public course. It just was owned by the Homeowners Association, and nobody there knew how to run it. And it was just a lead weight around the neck of the association, and they just wanted to be rid of it. So the association decided to sell it. So but I don't imagine there's too many of those around anymore now that things have picked back up.
Oh yeah. But yeah, I mean, if you find one, bring it to me and let me just at least look at it. We'll go from there. Okay.
Sounds good. All right, Tony, if you guys are looking to deploy any more money, let me know, because we definitely need a lot.
Okay. Sounds great, Jim. I'll talk to you soon.